how does cost segregation works as it relates to depreciation?
Right. So cost segregation is just like a friend of mine likes to explain. It's like depreciation on steroids. Okay. Mm-hmm. Now the name is really weird, but basically what it means is we are dividing up the assets in the building that actually depreciate at a faster rate. Like I said, the building depreciates, meaning you can take that deduction over a 39 or 27 year basis. I'm just going to use 27 and a half just because we're talking residential right now, just not to confuse and keep saying 27, 39. 27 and a half years is a long time to wait. Mm-hmm. And the IRS says that really things in the building, you should be depreciating each asset according to what its real life is. And they gave lives, depreciation lives to personal property, which is a 5-year life, which means carpeting, appliances, furniture, fixtures, your cabinets, all of that stuff, anything is not considered part of the structure of the building, even though carpeting, you would think it's like attached. No, it's considered 5-year property. That means you can write off that value in 5 years. But you can't do that unless you have an engineer, according to the IRS guidelines in cost segregation. And check it out. Anyone wants to Google this, the Cost Segregation Audit Techniques Guide. Okay, that is the booklet you can find on the IRS website, which goes into details of how to actually do this and implement this. And one of the principles is you have to have someone who has expertise and knowledge in the actual, doing of this, in the implementation of this, and that's an engineer who is specially trained to see, there's this X amount of light fixtures, there's X amount of square footage of carpeting. All of that comes back, prepares a report which details the cost. Okay, so now this is cost. That means the value, right? You have 100,000 square foot of carpeting in your building, in your 100,000 square. You have each one square foot of carpeting is, X dollars. That now translates into a value, and you can now deduct that from your taxes at a faster rate, meaning instead of lumping everything together over 27 years and taking $30,000 each year on that building, you can now front load a huge amount of that. We're talking 20%, maybe 30% into the first 5 years. Mm-hmm. And now you're getting, double or triple the amount of depreciation in those first 5 years than you would have otherwise.